Now, normally I would do another store bites the dust. But I feel like I'm starting to play that out. This is happening so much. I'm going with Michael Jackson. This is becoming worse than a horror movie scene. Brick and mortar meltdown. You ask me, what do I mean? Bankruptcy advisors. That's what I see. I just did one of these videos. Well, there's another one. Speaking of retail meltdown. Bankruptcy. Brick and mortar meltdowns from Wall Street. Bonton Department Stores hires bankruptcy advisor. Bonton Stores Inc. Well, Vitamin World plans to file for bankruptcy. Perfumania Holdings just filed. And Toys R Us all in 2 weeks. Bonton Stores Inc. Which operates about 260 department stores, largely in the Northeast and Midwest, under the names Bonton, Bergner's, Boston Store, Carson's, Elder Beerman, Herberger's, and Yonkers, has hired PJT Partners, which describes itself as a leading advisor to companies and creditors in restructurings and bankruptcies around the world. In a store around the world. Faced Faced with falling sales and customer traffic, the company is trying to refinance debt and prepare for a possible bankruptcy filing. People familiar with the matter told the Wall Street Journal. Bonton had already hired turnaround firm Alix Partners to help improve its operations, but added PJT to focus on the financial aspects. The people told the Journal. Bonton's debt and shares found their way onto Wall Street for the first time in November 2015 in an article published that they titled Capital Destruction Rages Beneath S&P 500 Tranquility after it reported crummy results. Speaking of crummy, name this movie. A crummy commercial? Be sure to drink your Ovaltine? A crummy commercial? Yeah, and crummy results, blaming the unseasonably warm weather and continued weakness in overall traffic trends. That day, it's already beaten down 8% notes plummeted. It's already beaten down 8% notes plummeted well below 40 cents on the dollar, and its shares crashed 39% to $1.21. In January 2016, Bonton's 8% notes reappeared in default and restructuring next for retailers, article they published, at which time they traded at 33 cents on the dollar. Yesterday, the notes traded at 40 cents on the dollar, and the stock was down to 69 cents a share. In May 2015, shares had traded around $7, to give you an idea. $7 2 years ago. 69 cents. Now, if that was a reversal, like a Willy Wonka, nope, reverse that, scratch that. This would be a cryptocurrency or a token. 69-cent ICO, it's now worth $6 or $7. But that's not how stocks roll. They don't move like that. But nonetheless, 2 years, $7 stock down to 69 cents. Again, you're not a bank. You don't get the banker bailout. You don't get the get out of jail free card. You get nothing. You are too small to care, not too big to fail. Sorry about that. In May 2007, at around the peak of the boom in leveraged buyouts, once again another one, when there were hopes that a private equity firm would buy out the retailer, as they had done with so many others that have now become part of the brick and mortar meltdown, shares had spiked to over 56 bucks. Could you imagine if you were in that one? 2007. but the LBO did not happen. So signs that Bonton was in trouble have been out there for over 2 years, but in an era of unlimited liquidity and artificially low interest rates, waiting for the inevitable requires patience. You and I just need a little patience. Excuse me. Sorry, I had to channel Axl Rose for a second. Patience is up. And we're here now. Little patience. In the last quarter, Bonton reported that sales fell 7% to $505 million on dropping customer traffic. Sales have been falling falling every year for at least 3 years. Its growing online sales did not make up for the plunge in brick-and-mortar sales. Bonton generated a quarterly net loss of $33 million on top of the $134 million it had lost over the past 3 years. It reported total long-term debt of $856 million plus about $300 million in capital leases, financing obligations, and, love this one, other long-term liability. I love the other one. You don't know what it is, but usually it's pretty damn big and pretty important. Other. Its cash balance was down to just $6.3 million on July 29th, and on July 29th, it still had $171.5 million available to borrow under its credit line with one of my favorite banks, Bank of America. So it's, matter of fact, let me give you a hint. Any too big to fail bank is one of my favorite banks. But JP Morgan and Goldman Sachs are probably my top two favorite, if I had to pick one, you know. So it's not going to run out of money tomorrow, but the day is approaching. In its report on retailers in July, Standard & Poor's warned about weak recovery for creditors in case of default by a slew of retailers that are headed for a debt restructuring or bankruptcy, including Bonton. And it pointed out that a number of recently defaulted retailers weren't able to restructure and continue, but instead have largely closed shop and liquidated their assets. Among them were The Limited, American Apparel, Wet Seal, and Sports Authority, all heroes of our brick-and-mortar meltdown theme. Alas, recovery prospects in a liquidation scenario are often dramatically lower than when a company continues to operate, and this is especially true in the retail sector because most retailers are asset light, meaning most creditors are highly dependent on profitability and cash flow as a source of repayment. Indeed, what assets does a retailer have that leases its stores? Inventory to be sold off at liquidation sales. Bonton lists $658 million in merchandise, which is likely worth less when sold at a fire sale, of course. But it has $200 million in accounts payable, $856 million in long-term debt, and $300 million in other obligations, plus things like accrued payrolls and benefits. So creditors are going to come up woefully short in a liquidation. Bonton is just the current episode. On September 6th, Toys R Us, which I just discussed, was said to have hired a bankruptcy law firm. The company was subject to $6.6 billion LBO in 2005, and by now the private equity firms involved, there's three of them, have stripped out cash and piled on enough debt to topple the company. On September 5th, Vitamin World, this year, a vitamin and supplement seller with 345 stores, was said to have plans for a bankruptcy filing as early as this month, hoping they get out of exorbitant lease agreements for a number of its stores. People familiar with the plan told Reuters. CEO Michael Madden, not to be considered with the game, was the Xbox game, Madden 2014, 15, 16, 17, 18. Anyway, CEO Michael Madden said that the agreements were negotiated by its previous owners, vitamin maker NBTY Inc. The current owner, private equity firm Center Lane Partners, acquired it last year for about $25 million. On August 26, Perfumania Holdings Inc., a fragrance retail chain, filed Chapter 11 bankruptcy with plans to reorganize around a core of its better performing stores and shed the remainder, according to the Wall Street Journal. The company had about 336 stores before 2015. Since then, it shuttered almost 100 stores, and now it wants to shutter another 64 stores, which would leave it with around 162 stores. The company, which lost money in each of the recent years, is impacted by many of the same macroeconomic challenges plaguing the retail industry as a whole. CEO Michael Katz said in court papers, declining mall traffic, the shift to online retail, changing trends, and expensive leases. Like a schnozberry, tastes like a schnozberry. Like a banana, it tastes like a banana. Expensive leases are a common theme among failing retailers. Under the Fed's asset price inflation efforts, commercial real estate prices have soared over the past 8 years, and landlords have relentlessly jacked up rents, but that equation does not work out in the real economy, where brick and mortar retail is already struggling mightily, and bankruptcy is one way to get out of those leases, and it sounds like an increasingly common solution. Again, ain't no bailout for you guys. The Fed might be pumping up the stock market, but it's only pumping up the big companies in the stock market. Some of the Dow Jones and the S&P companies. You retailers and your shares, Federal Reserve isn't going to give you the time of day. Because if they did, your stock prices would not be 69 cents. It'd be back to 50, 60, 70, 80, maybe $100, all-time highs. Which in that case would get you out of all the debt. No problem. Pay the high rent or retail lease prices. No problem. But you're not a bank. And only the too big to fail banks get the super duper bonus buyout package from the Fed. And all those big fat CEOs with their massive amounts of shares in those companies, banks, means when they cash out, those prices are looking real good. Well, not necessarily the banks. I should say the big companies. Not the banks, the big companies. The Googles, the Amazons, S&P 500 companies. Those guys. They get to walk out with their massive golden parachute. Now, anyone else? Insider trading, we're going to go after you. Insider trading, we're going to go after you. But isn't the Fed pushing insider trading themselves? Hey, the Fed's got our back. We're one of these giant corporations in the S&P or the Dow Jones. Yep. Well, in that case, we know where our stock's going. Buy in, baby. Buy some more. Oh, look at that. It's getting pumped up as I speak. And then when they leave, sell it. Well, that's not insider trading. Well, you know the Fed is going to pump your stock up because you're a giant company. What's the difference? You know they're currently actively bailing you out. Plain and simple. Anyway, on to the next one. Take care.